Hello everyone and welcome back to another financial planning video. My name is Erin Varghese and I am a financial planner here at Pure Portfolios. In our last planning video, we helped answer one of the most popular questions that we receive from retirees and soon-to-be retirees, which is, how much do I need to save for retirement? When we sit down with clients and have the planning conversation for retirement, a lot of what we hear about is their dreams and what their lifestyle is going to look like in retirement. This includes things like vacations, traveling, they want to buy a second home, if they plan on helping their children financially, any charitable or giving wishes. And we get a lot of questions about whether their assets will make those dreams possible. But the one question that we really don't hear very often, and it's a big piece of the retirement puzzle, is taxes. Nationwide does an annual income retirement survey, and 41% of retirees surveyed reported wishing that they had better prepared for taxes in retirement. What we often hear from this is that clients want to be better positioned to pay less in taxes and keep more of their nest egg in their pockets. So we know that taxes are complicated. Tax laws change frequently. Different types of income get different tax treatment. But if you're strategic enough, proactive tax planning can help you save thousands in retirement. You just need to know the rules and take the right steps. So here's 5 things that you need to know about taxes in retirement. First things first, tax rates are not always going to be lower when you move into retirement. Many assume that this is going to be the case when they stop working, but oftentimes what we see is that tax rates either stay the same or get a little bit higher into retirement. So picture this. When you're working, you have several different areas where you can take tax deductions, such as 401k contributions or HSA contributions. These types of things help lessen your tax bill at the end of the year. But when it comes to retirement, we have a lot of changes. Sometimes people make the push to pay off their mortgage before they retire. Of course, this helps on the expense side so that you don't have to pay a mortgage, but you also lose that mortgage interest deduction. So as your life shifts from working to retirement, your sources of income are potentially going to shift as well. We oftentimes see retirement income sources changing from salary to investment plan withdrawals, and that means that you could have a potential change in your taxation as well. So the second thing you have to consider is your RMDs. RMDs are your required minimum distribution, and this is the minimum amount that you must take out each year from tax-deferred accounts in retirement. RMDs currently start at age 72, and you're required to take out 3.65% of that account each year, and this percentage increases each year throughout retirement. This has the effect of not only limiting your potential growth in your retirement accounts, but also increasing your income and thus increasing your taxes in retirement as well. RMDs can also have an impact on your Social Security and Medicare, but we'll get to that a little bit later in this video. One solution is to do a Roth conversion in your retirement sweet spot. This is the window where your income is lower because you've stopped working, but before the age of 72. It's essential to find a balance between investing in different types of accounts because they're all going to have different tax advantages. Number 3 on our list is to remind you that you cannot forget about Social Security and Medicare Part B premium surtax. Most people think about Social Security as tax-free income. I mean, after all, it's taxes that you paid while you were working, but unfortunately, that's not always the case. In 2021, depending on your income level, up to 85% of Social Security benefits can be taxable. In addition to taxation on Social Security, higher income retirees may be subject to an additional taxation on investment income. This is called the Medicare surtax. This is a surcharge on your Medicare Part B premium that applies over certain income levels. This is why it's so important to understand how much you need and how to structure your accounts and any asset sales to make sure that you have consistent income in a year-to-year plan. So for example, if you were receiving income before you retired of $5,000 a month, that doesn't necessarily mean that we need to withdraw $5,000 every single month from your IRA. So this is why it's so important to understand exactly how much you need, how to structure your accounts and withdrawals so that we make sure that we have consistent income year to year. Number 4 on our list is to keep in mind that taxes on estates may be changing. Given the likelihood of some changes to estate plans in the future, it may be a smart idea to start thinking through some gifting strategies. This could either be to family or a charitable institution. This could mean exploring the use of trusts. Trusts are extremely flexible and have the added benefit of avoiding probate. If you have appreciated stock, you can gift that stock directly to a charity. You won't incur any capital gains, and if done correctly, can count for your RMD for the year. Finally, number 5, how you file matters. In recent years, the standard deduction has actually become a pretty attractive option for those who have historically itemized their deductions. The standard deduction is a great way to save time and simplify your taxes. If you don't have a mortgage or property taxes or charitable contributions, standard deduction may be the way to go. It all just comes down to running the numbers. At the end of the day, taxes in retirement can play a big role in your overall expenses, so they must be managed carefully. By knowing how different types of income is taxed and what your different options are, you can begin to develop a strategy that helps keep more money in your pocket, both now and into retirement. So if you're looking to navigate some of these big retirement questions, or you just want to get a plan in place, please don't hesitate to reach out to our team at insight@pureportfolios.com. We'll see you next time. Bye.